Hi friends, welcome to Baroda BNP Paribas Monthly Outlook. I am Alok Sahoo, Head Fixed Income. Before we speak on the outlook for the current month, June 2022, let us look at how the fixed income markets has performed for the previous month of May 2022. Debt markets seem to have shifted away from their traditional mandate of providing stability and have in fact witnessed a high degree of volatility in the recent past. Of course, this volatility was inevitable considering the unscheduled rate hike by the RBI, hawkish US Fed, and higher crude and commodity prices that hit the markets during the month of May. The 10-year yield hardened by 58 bps to 7.42%, while the yield curve moved up by around 60 to 120 bps across the curve, with the yield curve flattening in the month of May. Further, the short-term rates hardened with the 3 months and 1 year T-bill moving up by 90 bps and 118 bps to 494% and 594% respectively. Overall, the liquidity has tightened. The month saw a slew of macroeconomic numbers that had an impact on the debt environment. First, the GDP numbers. These led to a bit of cheer. The Indian economy grew at 8.7% in 2021-22 and at 4.1% in the fourth quarter of the financial year. GDP levels in 2021-22 have crossed pre-pandemic levels on the better performance by various sectors such as manufacturing and construction. Second, there is inflation. This continues to be a cause for concern. Consumer price inflation for April moved up sharply to 7.8% due to increase in both food and core inflation. Food inflation moved to 8.4% due to a sharp increase in vegetable prices. On the positive side, the government reduced diesel and petrol prices and announced a host of measures in a bid to control inflation. These measures may impact headline inflation by 30 to 40 bps. Even though May inflation may come down marginally to 7%, we expect it to stay elevated in the first half of FY23 due to higher food and core inflation. The RBI has turned hawkish and is expected that it may front-load the rate hike due to high inflation. It is expected to normalize the repo rate to pre-COVID levels of 5.15% by August of this year. However, if inflation continues to stay at elevated levels above the upper band of 6%, then RBI may consider hiking the repo rates further to 5.75% to 6%. We expect the 10-year yield to trade in the range of 7.3% to 7.6% in the near term due to concern over higher supply, hawkish RBI, higher inflation, and sharp increase in rates by the US Fed. Having said that, increase in HTM limit and operation twist may cap any upward movement in the yield. The yield curve has flattened due to the expected faster normalization by the RBI. The corporate bond spread is at very low level and may widen with an increase in supply. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.